Hey guys, Sean here at K2 Trades. Today I'm going to be going over pips, lot sizes, and order types. So let's start off with a pip. A pip is a unit of measurement demonstrating the change in value between two currencies. If GBP/USD moves from 1.0001 to 1.0002, that 0.0001 USD rise in value is a 1 pip increase. Majority pairs go out to 4 decimal points, but some pairs only go out to 2 decimal points like the Japanese yen, as you can see below. Next up is a pipette. A pipette are fractional pips that go beyond the standard 4 or 2 decimal places out. For example, if your USD moves from 1.00001 to 1.00002, that 0.00001 USD move higher is 1 pipette, as you can see below. Next up are lot sizes in FOREX. A lot in FOREX demonstrates the position size you are taking when you enter a trade, and it comes in many different forms equal to your risk taken. So if you look at the chart below, a nano lot is equal to 100 units, a micro lot is equal to 1,000 units, a mini lot is equal to 10,000 units, and a standard lot is equal to 100,000 units. To keep things simple, we will demonstrate a pip's worth with regard to lot size when applied to major pairs, since the conversion generally provides for a whole number that will be easier for you to understand. However, a pip's worth when trading other pairs such as minors will generally be less or more depending on the currency traded. So if you look below, we analyze EUR/USD per pip, and if you're trading a standard lot, each pip is worth $10. When trading a mini lot, each pip is worth $1. When trading a micro lot, each pip is worth 10 cents, and when trading a nano lot, each pip is worth a penny. Whenever you enter or exit a trade, you will be subject to the spread in the bid-ask quote. When you take a buy position, you'll use the offer or ask price. When you take a sell position, you'll use the bid price. Next up are types of Forex orders. There are 3 types of orders you can make when entering or exiting a trade, and those order types are market orders, limit orders, and stop orders. As you can see below, there are different variations to these order types of which you may enter. A market entry order enters or exits at the best available price. A limit entry order is placed below the market for a buy order or above the market for a sell. In opposite, a stop entry order is placed above the market for a buy order or below the market for a sell order. A stop loss order is used to set a designated maximum loss price point for your position, and a trailing stop order follows price as it moves into profit. Here's an example of a market order entry. If you enter at market price, you will be entering at the current market price here as displayed in the chart. Here's an example of a limit buy entry order. If you are trying to enter a buy position at a price point below current price, it will be a limit buy order like set here in this chart. Next up, we have an example of a sell stop entry order. If you're trying to enter a sell position at a price point below current price, it'll be a sell stop order like set here in the chart. Aside from the 3 order types that are used to enter and exit a trade, you may also use a stop loss order. A stop loss order is used to designate the max you are willing to lose before being taken out of your position. So here's an example of a stop loss order if you're entering a buy position. And lastly, we have trailing stop loss orders. If you set your stop loss to a trailing stop loss order, then the stop loss will adjust as price moves into profit, and it will continue to do so until price triggers it. So as you can see from the chart below, if you enter a buy order and set it to a trailing stop loss, as price moves into profit above, then the stop loss will follow it. But as soon as price pulls back and retraces, it'll trigger your stop loss and you'll get stopped out in profit. In the next module, we'll be discussing Forex trading sessions.